So to explain how I would present a loan or future loan to the lender for assessment, I'd first present a loan application by detailing applicant name, any dependents, loan purpose, security property details, loan details, the LVR, LMI if applicable. I then state the borrower's purpose, their needs and objectives, employment history, income used for servicing, and justify or show calculations as to how that was done. I would address existing liabilities and anything worth noting. I would also address living expenses and anything worth noting. I would present exit strategies if applicable or appropriate. And where necessary, I would address any exceptions to policy or special situations that were worth noting. Point 2, discuss 5 key points you would detail in your loan submission. In the client needs and objectives section, I would detail what they are, address why the loan products were, address which loan structure they selected, and that it fits within their purpose. I will also note if there was any professional advice that was taken into consideration, such as like tax advice or financial advice. So for example, saying borrower is purchasing an owner rock, after pre-approval of X amount, based on a purchase price of X amount, and funds to complete is X amount. Preference is variable rates for flexibility of extra repayments, and to also redraw funds if required. Offset account to take advantage of interest savings. I would, the second point is about the borrower and their income. So I guess point out current employment situation, highlight industry experience, point out stability of income, or make note of the loss that was carried forward. Present the last 2 financial years figures, present current year-to-date figures, make a note of future income with the new employment contract, explain how the income figures were calculated, justify add-backs appropriately. Third point, mention current liabilities, anything that was recently paid out and closed, and supply documentation. Comment on, for example, the store card facility, because it was for interest repayments on a TV, and that the intention is to pay out and close the facility. If the credit card limit was decreased, to have a letter showing that. Point 4, living expenses. So make special mention of what general living expenses are, comment on any discretionary living expenses if that's applicable, note any expenses that could be declared as part of the business, or declared in the tax return. So maybe like a mobile phone bill, for example, some travel expenses if they travel for work, and just make mention that because they're declared as a business expense or claimed as a business expense, then they're not included as personal expenses. Just address any I suppose, outliers. So if there was one-off expenses, to exclude these as they're not an ongoing expense. Point 5 would be I would expand on the borrower's past financial issues and explain how they came to be, because their credit history and credit score are likely to have been impacted by all the late payments, or the defaults, and the collections, even though everything's been sorted out. I would comment on the borrower's commitment to addressing their previous financial issues, and that it's evident that they've obviously, business has been performing well. It was a result of personal issues, and there's been good conduct on current and recent credit facilities since. Question 3. So prior to the appointment, we were asked to provide an estimated repayment amount and product options for discussion. So explain how you achieved the repayment amount and why you identified these product options. So the task actually asked us to provide the client with an idea of how much they could borrow. So I did this with a serviceability calculator that was provided when I was doing my Cert 4. Pardon me, I used preliminary figures that were input. I made some assumptions, like living expenses for a single adult, no dependents, because I made the assumption that her and her partner were not living together, so therefore the household expenses are only for one adult. Repayments are actually provided on the serviceability calculator anyway, based on the it provides the yearly commitment for that, but I also just plugged in the loan amount, the loan term, and the interest rate on basically any online home loan repayment calculator that's available with any major lender. I identified variable loan products with offset accounts as products that were not unsuitable to the client, because in general at the moment variable rates are higher than fixed rates almost across the board, or at least there's enough fixed rates that are lower than variable rates, and so because the higher the interest rate, the lower the borrowing capacity. So I took a conservative approach that if the client can afford the variable rate, then she can afford a comparatively lower fixed rate. The client shows a good savings history. Like, so she had 64 grand. So an offset account would help her save on interest charged on her loan, because anything that she can put aside, she can pop in the offset account.